Good morning. We're just half an hour away from the market opens in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm Yvonne. Man, if you're wondering where David Ingles is, he's right there, straight at the Bloomberg Wealth Summit right here in the city, where he is going to be speaking imminently with the Hong Kong Monetary Authority Chief, Eddie Yue. Let's listen in.
So we're at the Wealth Summit, and one of the things that I constantly grapple with is how Hong Kong as a city measures its progress as a wealth hub, and what the HKMA's role is in ensuring that you are on path for those objectives.
Right. Well, as you know, Hong Kong has been the largest asset and wealth management center in Asia for a number of years. And we are continuing to improve our platform through a number of initiatives that we do in collaboration with other regulators and also with the government. Let me just give you a very broad survey of what we've done just in the past year. There are three areas that we've pushed out new initiatives. One is the new schemes introduced by the government. One is on single-family office, a tax concession scheme. So if any single-family office comes into Hong Kong investing $30 million US dollars, and they will be entitled to the tax concession. The second one, and I was told by many private banks here that the response from the clients has been very enthusiastic. So I'm glad to see that. And if there should be any further refinements to the regime, do let us know, and we are very happy to take it up. The second scheme is called the Capital Investment Entrance Scheme. That was just introduced in March. So for any individual investing about $4 million US dollars into qualified assets in Hong Kong, they can get a Hong Kong passport. And I was told again by the government that in just 2 months, they've already got 50 applications. So the response has been quick and quite positive. And this actually brings in new sources of capital into the wealth scene of Hong Kong. The second area is to increase the connectivity of the wealth products in Hong Kong with the mainland. And you're aware of the Wealth Management Connect 1.0 that was introduced about 18 months ago. It was a very cautious start with restrictions on quota, on products, or even on selling process. But it was a smooth start. That's how you do relaxation in China. You have an orderly, smooth start, and then you try to widen it. And we did the widening at the end of February with Wealth Management Connect 2.0 by increasing the individual quota, relaxing the eligibility criteria, especially for the southbound flows, capital coming from the mainland individuals to Hong Kong, expanding the suite of product from just bonds into equities, and make it easier for the marketing and selling process. And the numbers that we see in March and April coming into May is actually a very significant increase in the southbound flows, both in terms of the number of new accounts and in the remittances that were made. And of course, we will not stop there. We are already looking into whether there could be possibilities of Wealth Connect 3.0, and if so, what could be in it. And we are talking to the industry very closely about what's needed. Is it a quota, or is it the scope of products, or is it the selling process? So the connectivity has been increased very significantly through the Wealth Connect 2.0. And just very briefly on the third area is on our own regulatory arrangements. There's always a balance between regulation, especially investor protection, and the ease of business for our wealth managers. And taking account of the feedback from the industry, in July last year, we, together with the Securities and Futures Commission, introduced a new circular, basically making it easier in terms of certain requirements in suitability and disclosure for the wealth managers to deal with what we call the sophisticated professional investors. So that means the wealth clients with a certain asset amount and with certain experience, they can actually waive some of the suitability and disclosure requirements. So and all these three tracks, new schemes, new capital, connectivity, and regulatory refinements, are actually an ongoing process. And we welcome continuous discussion with the industry so that you can actually tell us what we should do to even further enhance our wealth management center in Hong Kong.
Right, and I think Amy and Annabelle are here, of course, to talk a little bit more about what they want to hear, hear from Eddie. Wealth Management 3.0, do you have a rough timetable of when you want to get that in place? And also, based on the feedback that you're hearing from market participants, what's a sense of what they want?
Well, I think it's still early days. We've just introduced Wealth Connect 2.0. But whether, I think Amy and Annabelle will tell you more what they want. But there are things like, for example, the quota.
Okay.
Currently, individual quota is up to 3 million RMB, but that's actually not quite enough for private bank clients. Is there a way to have a separate channel to capture the private bank clients? The selling process, it's been a lot easier and smoother than before. But can it be further streamlined, or can the marketing be made a bit more active? Can the education be done better? So I think there are still areas that we can look into in terms of improvements.
Okay, yeah, and you bring 3 million Hong Kong dollars. That's tiny, Eddie.
3 million RMB.
RMB, that's still tiny.
Here you're talking about mid-wealth, which actually has the biggest need for diversification on the mainland.
Right. Okay.
Because for the ultra-high net worth, they've got their ways of investing globally. But for the mid-wealth, for the middle class, they need to diversify. Most of their assets, personal assets, are actually either in the housing sector or in Chinese equities. And they have a very big need for diversification. And I think Wealth Connect actually provides them with this easy, convenient, and ready access.
So the affluent, the poorer of the group, as they say. Now, there's been certainly conversations on our shows a lot, and we have a lot of asset allocators here. An increasingly bigger allocation of people's wealth are going into alternatives outside the public markets, into private markets, real estate infrastructure, private equity, private credit. As a regulator looking at that, that's an area of the market that is less liquid, it's less transparent. Are you concerned over the risks? How are you looking at that from a financial stability perspective?
Right. As you know, we ourselves as an investor has been going into private markets for 15 years already. So we kind of know the market. And you're right in terms of the risk profile and especially the liquidity. When I look at for example, private credit has been a very trendy area in the last
like bubble tea,
like bubble tea.
Yeah.
And when I look at it from the financial stability perspective, I thought there are individual areas that we will need to look at. For example, the lack of data, the leverage that they're having, etc. But I don't think, at least for now, that the industry is creating any systemic risk to the financial system for several reasons. One, if you look at the majority of their investor base, is mostly long-term institutional investor who can sit out through cycles, who don't really have big liquidity needs. So there's not really a lot of liquidity mismatch in that portfolio. The leverage that we see from individual private credit funds is actually not big. They just use the client's capital to lend to those in need. And in a way, they're filling in the need that's left by the banking sector, the more risky part, the mezzanine. And they also go into some of the companies to help them turn around. So I thought the systemic consequences so far is limited, but it's an area that we will collectively in the regulatory forum, we will need to continue to keep an eye on and try to gather more data, especially in a few areas. One is as I said, leverage. And second is the interconnection with the banking sector. Will there be more interconnection? So far, currently, there's not a lot. But will in future, the banks and the private credit companies will actually collaborate more by underwriting, by even participating in loans. The third one is whether private credit and private market will be further retailized. If you further sell it to retail market where people have different liquidity needs, they might want immediate liquidity. When these markets are very illiquid, there will be a mismatch and there will be problems. So I think these are the three areas that we will keep an eye on, but so far is manageable. Plus in Asia, I think the industry is growing. But compared with a very bank-centric system in Asia, private credit is still very, very small, but we'll keep an eye on it.
Yeah, and not to scare anyone, but is more regulation the answer, you suspect?
Well, at least more transparency, more data.
More disclosure?
So you know what's going on there. More disclosure and for the regulatory community to collect more data on not just private credit, but generally on non-bank financial institutions that cover private market and also, for example, hedge funds.
Right. Just to pivot very quickly, I know we're running out of time. Hong Kong has been very active, increasing its links with the Middle East, back and forth. What's something we can expect to see this year as far as?
Well, we've been actually focusing on two corridors: building infrastructure, building business links. One is the China-Hong Kong Middle East corridor, when we see a lot of trade investments flowing through this corridor. The other is China-Hong Kong ASEAN corridor. Again, China is the biggest trading partner of ASEAN countries. And I was in the Middle East, both in Riyadh and Abu Dhabi, Dubai last year, having bilateral talks with the central banks, trying to create more payment links, for example, infrastructure links. And I was also bringing the banking associations to, for example, UAE, trying to build business links. There's actually a very strong wish of the two central banks to build these links together with us to enhance more trade to be settled, for example, in RMB. Currently, it's all in US dollar. Why not diversify some into local currencies, whether it's RMB or whether it's dirham? And there's a lot of interest in investing into this part of the world as well, Asia in particular, China and Hong Kong. But there needs to be more education. They need to know the means to get into this market, how to use Hong Kong through the Connect schemes to enter the Chinese market. Right. So I think there's a lot that we can do together to enhance this kind of interlinkage between the two regions.
Are there any specific programs that you think would be in place in the next 12, 24 months?
There's one that's already in place, that's already entering the minimum viable product. I thought I mentioned a project called Enbridge last year. It's a CBDC, Central Bank Digital Currency project, trying to enhance cross-border payment, make it faster and cheaper. It's done under the BIS umbrella with China, Hong Kong, UAE, and Thailand participating. And it's a lot faster. It's almost instantaneous settlement, a lot cheaper than the current cost. And we've already entered the minimum viable product stage using trade settlement as the use case. And UAE is involved. And very shortly, there will be another Middle Eastern country joining.
Okay, I think we're down to our last 90 seconds. I think we have some questions from, on the lighter side of things, Eddie. We'll get to our favorite topic in a moment for the last seconds or so. The advice for young people on building wealth.
All right. It's very hard, but I thought be patient. Don't believe in anybody who tells you that there's a product that's low risk and high return. It doesn't exist. And if somebody tells you that, it's likely that they are scammers and they're trying to scam your money. So you need to protect your savings. That's one. But the medium longer term, I still believe in diversification. That's actually the focus of the exchange fund. Even as a very, very big institutional investor, we actually claim to diversification. Diversification is the best way to have a even risk-adjusted return in the long run.
The best investment you've ever made? Money or not money?
Because being in my position for such a long time, I have a lot of too many restrictions on investments. Okay. So my best investment and only investment that I have is fixed deposit with many of the banks here. So and you don't want to you don't want to imitate that.
Well, which bank offers the best deposit? Because
many of them.
Can hold them to account. Huh?
You know me. I do shop around.
Anything, last 15 seconds, anything on the Hong Kong peg?
is not going to change, for the record.
Okay.
Now and
okay, you'll give us a heads up, right, in case it changes. All right, that's all we have time for. Thank you so much, Eddie Yue, ladies and gentlemen. Thank you.
All right, thank you very much.
All right. Wide-ranging conversation there with David, with, of course, the HKMA head, Eddie Yue, talking a little bit more about ways that he wants to really up the wealth quota products there and really ways to really expand that wealth connect here in Hong Kong as well. We're going to have plenty more coming up from the Bloomberg Wealth Summit in Hong Kong. We'll be hearing from Amy Low from UBS, Ronnie and Adriel Chan, the father and son from Hang Lung Properties, and Bonnie Chan, the Hong Kong Exchange CEO, speaking with Stephen Ingles throughout the day as well. A quick look at the market action as well. You know, you certainly have been talking a little bit more about India. That certainly is still a top story here today, but we're tracking beyond that here this morning. We're still a little bit on the back foot when it comes to equities. You watch what's been going on in the Treasury market. So that rally seems to have stabilized a bit, but it's been a massive drop in yields. We're talking about close to, I guess, double-digit drops in yields on the 10-year, and we saw the biggest two-day decline in yields on the 10-year all of this year, basically, on the back of that JOLTS data. So it's been a combination of bad data now, from the ISM to now the labor market. We'll see how the jobs report fares in the end of the week here, but the job openings basically hit the lowest since 2021. Fed swaps now are also now pricing in the first cut in November. There's also higher odds that we might see a cut in September now. So you're seeing Asian bonds really track that rally across treasuries here. We're still watching oil markets, just given how we've seen, I think, about 5 or 6 days now of losses there after that OPEC Plus meeting, of course, and we're basically falling to the lowest in 4 months or so. Copper also falling below 10,000 as well if you look at those LME contracts. So certainly that's given a lift to dollar yen in some ways, 155.32 for the currency. We also have the euro. That's slightly weaker here this morning, but we have also a Bank of Canada decision later on. Also could be talking about a pivot to cuts as well. You tip of the boards here and watch what happens in India futures here this morning. Looks like things have stabilized just a little bit after what was the political shocker that people did not see coming, or at least these markets, of Narendra Modi's BJP party losing that majority for the first time since he took power. And basically, on a percentage basis, we saw the Sensex fall the most in 4 years. If you look at just wealth destruction overall, it may have been one of the worst we've seen in history out of India. Those Adani assets certainly saw a massive plummeting there. We'll check how things fare out, but looks like things could be stabilizing, at least in the green, as futures are pointing out here today. The China approach is looking like this here at the open. Looks like we're poised for some gains here as well. 230 for your Chinese 10-year yield. We're not seeing a whole lot of movement in the currency. That fix just crossing the last few minutes, 710.97. We're focusing a little bit more on the auto sector here today. Property did really well yesterday, so we'll see if that continues. Of course, we're counting down to those opens coming up at the bottom of the hour. This is the China Show.
Today's victory is the victory of the world's largest democracy. This is the victory of unbreakable allegiance put into the Constitution of India. In our third term, this country will see a new chapter of big decisions. This is Modi's guarantee.
The main thing that this election has said, the country has unanimously and clearly stated, we do not want Mr. Narendra Modi and Mr. Amit Shah to be involved in the running of this country. We do not like the way they have run this country.
That was the Indian opposition leader Rahul Gandhi there, and the Prime Minister Narendra Modi speaking after that surprise swing away from the ruling BJP in national elections. Let's get to our Bloomberg Markets Asia anchor, Hazlinda Ahmed. She's been in New Delhi working furiously here the last few days, and what a shocker this has. And then the first question really is, what went wrong for the BJP?
Well, obviously a lot went wrong, Yvonne. This is the largest democracy in the world. And Modi himself said that. And the people have cast their votes rejecting the status quo. They want change. Modi talked about the Modi guarantee. Well, he's talked about the Modi guarantee for some time now, and including during his campaign, and that Modi guarantee has not worked for the people at all. In terms of how it landed after the vote count, we have Modi's BJP party securing 241 seats. Now, that is the biggest number of seats for any party, but it falls short of the single-party majority which the BJP has had for the last two elections. The number to get is 272. Now, what that essentially means is that the BJP has to get the support of its allies, the two allies in its alliance. But the problem is this, really. The leaders of the two parties are unreliable. Historically, they have flip-flopped in terms of their allegiance, depending on what they get in return for their allegiance. So it remains to be seen if Modi's BJP can convince them to fall into their camp. There is a risk that the two parties will decide to go with the opposition. So in the coming days, expect horse trading. Essentially, you can expect the same from the opposition. They secured about 229 seats. They will try to get the seats from Modi's allies.
Yep, and what does this all mean for, of course, Modi's reform agenda is certainly the big question there. Haslinda, thank you. Our Bloomberg Markets Asia anchor, Haslinda Ahmed, joining us from New Delhi with the latest. In the next hour, we'll be looking at the economic implications of a weaker BJP mandate. Emkay Global Financial Services, Madhavi Arora is going to be joining us and why she sees some market reforms slowing. And what does this mean for the economic growth story for India? We have plenty more coming up. This is Bloomberg. All right, we are taking a look at this pre-market. Looks like we are looking decently well, slight gains here when it comes to the Hang Seng. We're just trading around the 18,500 level or so. HS Tech is flat this morning. We're also watching that currency at 724.84, but futures in China also still looking pretty good. In terms of stocks to watch here, we're focusing on the EV segment a little bit. There was some news that the likes of BYD, also NIO, was able to get Trip.com, I should say. My apologies there. We're falling there after proposing this convertible note. And Citi did mention that could create some negative sentiment as well. We're also watching, as I talked about, the EV segment. So they've been talking about this on-road pilot for connected vehicles that did get approval. So we're watching a few sort of names here. It doesn't seem like it's moving the stock too much here as well. But we're still tracking that oil story, given the fact that we continue to see some downtrend when it comes to crude prices here. And we continue to see these energy stocks are falling in tandem with crude this morning. You're watching the China Show. The Open is next. This is Bloomberg.
Right, good morning and welcome back. You're watching the China Show. We're coming to you live out of several places today. As you can see, of course, that is a live shot of the Bloomberg Wealth Summit taking place here in Hong Kong. That is Animal Spring, of course, of HSBC, talking to our colleague Eric Schatzker on stage. I'm right outside, of course, where that is taking place here at the Conrad Hotel. Welcome to the program and good morning. And Yvonne, let me bring you back in, of course, to the conversation. It's not just about wealth. It's about these markets. It's about this ECB decision, of course, coming up. It's all about India. So there are different strands to the market story today, including might be some data coming through out of Australia in a moment.
Yeah, and you kind of wonder if, given just this wobble in India stocks, are we starting to see something of a correction? Is that going to help the outperformance in China in some ways, and maybe more rotation back into the mainland is certainly one discussion that we're looking at here today. So after we saw one of the worst sort of days in 4 years for India stocks, does that actually trickle through in any way to benefit China? Not so much so far in this open. If you take a look at how mainland markets are looking at right now, CSI 300 is slightly lower by about 1/5%. It looks like, you know, we're not seeing whole movement in the CGB market as well. Some of these big cap names are not seeing big moves either. So it's pretty slow going. If you take a look at how onshore is looking at here right now, there's not a whole lot of catalyst to really tell you about either. But it was interesting. Hyben Drew from JP Morgan was saying there is still now a risk that the PBOC may only just cut once this year. just given where the Fed story is and the like. So that certainly could lead to some concerns on the currency as well there. But you take a look when it comes to the Hong Kong market. Obviously, we've been talking about this Wealth Summit in Hong Kong, so a lot of news could come out from there. But here, you're seeing a better environment when it comes to offshore markets. We're up about 1/4%. Property still seems to be doing decently well. We're watching very closely what's been going on in the HS Tech side of things as well. Tencent, and Alibaba still doing pretty well. Alibaba's up close to 1% this morning. We talk about what's been going on in the EV segment. Perhaps that's what's helping to keep HS Tech a little bit more elevated here today. So some of these local car makers basically getting the okay when it comes to this sort of on-road connector or the like here. So it's a program that certainly we're watching very closely. We flip the boards. Can we take a look at how these automakers are faring? In the pre-market, they didn't quite react too much, but on-road pilot of connected vehicles. There you go. You're starting to see some more green across some of these automakers. BYD is up about 1% or so. We're talking about LONGi Energy or solar energy as well. Of course, they've been talking a little bit more about how the industry is basically going to have to adjust. Basically, there's been challenges. We talk about the price of solar and all that. So they are adjusting some of their production plans as well. The stock slightly in the red here. Trip coming up with a convertible bond, and it's leading to some negative sentiment around that. But I think it's about $1.3 billion. There you go. That's going to be due in 2029. The stock down some 3%. And yesterday, it was a killer day for some of these property stocks were actually doing quite well. We are now just down 3%. A little bit of a correction there for some of these stocks like Sino-Ocean and China Wanke. Dave.
Yeah. Okay. Well, let's get to some data coming through as well. And certainly it's a very important part as far as Australia goes. Several strands of the story. We're using the GDP numbers as a way to really get into this. So a slight miss, if you could even call it a miss here. That's according to the median estimate. Quarter-on-quarter, year-on-year numbers coming through bottom of your screens. What's perhaps more important is about an hour back, the RBA governor just concluded her testimony to the Senate there in Australia, talking about how inflation is something they're watching. It's something that they will take action on if it does not head back to the band. So it's something that she considers the risks are balanced as far as price action is, or price levels and price growth is concerned, although it is something that they're very cognizant of at this point in time and at this point in the cycle. And I understand, too, at the top of the next hour, the Treasurer, Jim Chalmers, will be speaking at 10 Hong Kong time, of course, and we'll see, of course, whether or not we get more context on these numbers coming through as well. And Yvonne, yeah, you're looking at some of these markets, too, there.
Yeah, we're looking at, what's been going on in the yields of some of these sovereign bonds, right? So we're down 8 basis points for the Aussie 10-year year. That certainly does show what we've been seeing across treasuries overnight, when you're starting to see data in the U.S. really start to kind of play out here. And that, I think in just the last 4 days, we've seen that U.S. 10-year yield fall close to 30 basis points, right? So there is a bit of a different narrative that's going on. It's not so much the inflation concerns now, but really about growth that might lead to this bond rally to continue. That's according to some analysts out there. At least when you see the U.S. 10-year yield, we stabilized a bit. We're basically just up about 1 basis points at 4.33 levels right now. Certainly, that the whole discussion about higher rates, how is that going to impact deal activity and fundraising, have both been impacted, of course, about overall this whole environment when it comes to asset managers. And let's talk to one of them now. One of the world's largest infrastructure investors, Macquarie Asset Management, its group head, Ben Wei, is joining us now this morning. Ben, it's great to see you here in the region. And obviously, it's been interesting, right? We talk about the growing concerns about higher for longer rates. It's also been a tougher environment for renewable energy in that market as well. There is this projected rebound in 2025 for you guys. Are those two factors in any way going to weigh on that profit rebound?
Good morning, and thanks for having me, Yvonne and David. It's always great to be with you. Look, I think there's no doubt the last year has been a much more difficult year from fundraising and also deployment, and that was simply to the fact that investors and asset managers and broader stakeholders were getting used to a higher rates world and trying to recalibrate their business cases, and as a consequence, we had a real spread between the bid and the ask between buyers and sellers. And I think as people have got more used to to the world we find ourselves in, and be able to rethink their business cases, rethink the sort of returns that have got in, and got more comfortable with the environment. Confidence is coming back into the market, and I think we're seeing that, that institutional investors are starting to allocate and be more positive about supporting fundraising, and equally we're starting to see the M&A market pick up. So I think we feel pretty positive about that. I think, as you asked specifically as it relates to energy transition, I think we've got to look beyond the headlines there. The amount of investing around the world has tripled in the last 3 years, from $900 billion to $1.9 trillion. More than doubled in the last 3 years. And I think that what that underlines is that there's a huge investment thematic here. But was there some pause or some repricing? There was, and that's appropriate, because things like the cost of capital and supply chains caused some friction, or the need for people to review the approach they were taking.
I think market consensus is still expecting, once this drought in sales of renewable assets starts to fade a bit, that your profits could surge as much as close to 90%. Do you think that's a bit of an ambitious target here right now? What would it take to get there, Ben?
Yeah, I mean, I think, so I don't think anyone's exactly sure how, sort of what the uptick will be and what that could mean results, and generally we wouldn't forecast that. But I think we're certainly cautiously optimistic. If you just look at some of the transactions that have occurred over the last sort of week, that there is a real appetite for investors to be exposed to energy transition. There is a huge slate of opportunities. We have more than 100 gigawatts of renewable energy in development, and there will be opportunities to monetize that over the coming years. So we're not in a rush to do that. We want to do that in an orderly way where it makes sense from a returns point of view. But I would say that we don't look at this thematic, and we don't look at this opportunity in sort of 1 year blocks. We think that there's an opportunity over the next 10 to 15 years to build a business that's the same size as our infrastructure business today, that has more than 180 portfolio companies around the world in energy transition. But that will not be a linear journey, and it is of course affected by things like interest rates and market confidence. But if you're playing the long-term game, I think we all see that this is probably the biggest investment thematic of our lifetimes.
Ben, David here, you mentioned infrastructure, you mentioned the longer term time horizon that you guys use in investing, which I guess in many ways keeps you agnostic to political cycles. I need to just get your thoughts on India and infrastructure. Those two things come to mind immediately, and with these results coming through, I just want to get your thoughts. A weaker mandate perhaps for Narendra Modi, does that change in any way the way you think about India?
Yeah, I think it's a really important question. So two things I'd say is, one, we've been investing in India infrastructure for more than 15 years. It's obviously a great market in terms of it has a real need to build and operate new assets there to help facilitate the ongoing growth of India, and also has a huge need for capital, particularly foreign direct investment. And we don't think that will change because of the Modi election. We think there continues to be very good tailwinds in India. But like all markets, as we go through a political process, there is sometimes the need to pause, or there may be a little bit more caution. But I think what's made India an attractive market over the last for the last 5 to 10 years will continue to make India an attractive market over the next 5 to 10 years, because there's a massive need for infrastructure. There's broadly very good supporting government policies, and I don't think that they'll change materially depending what happens in the next few months in India. And there's also a need for capital, and so that is really a very good combination of factors to see ongoing investment. And I think many of our peers around the world, like ourselves, recognise that and will continue to deploy capital in such a scale and important market.
And for a foreign firm like yourself, have you yourself noticed that things on the infrastructure side in India, have things really picked up during Narendra Modi's, of course, state in power? And do you expect that to continue, I guess, is the key question. In other words, is there a level of consistency that you're confident that we can expect still?
Yeah, I think that's our answer in short would be yes. I think the policy work that the Modi government has done over the last 10 years has been very significant. I think it's one of the most important and positive bodies of work, particularly as it has come in terms of stimulating and creating more opportunities for infrastructure investment. And I think that will continue on because India needs that investment. Infrastructure is the building blocks of developing economies and to develop nations. And so we wouldn't expect that to change. So I think that's a market that we remain very positive about, like many markets around the world.
What about markets like China? Obviously, there's a big push into infrastructure there. They've been talking about this $1 trillion infrastructure plan to boost the economy. Are you seeing more signs of opportunity there in China now, especially as you talk about renewable energy, which is a big priority for the president?
Yeah, I think two things there. I think, first of all, China has done a very good job of driving its own infrastructure development, particularly over the last 25 years. I think there was more renewable energy invested in and installed last year in China than the rest of the world combined. And often that's being done by highly competitive, very high-performance local companies in China. I'd say from an international investor's perspective, I think everyone understands that, besides the US and India, China is one of the most exciting and scale markets to invest in, particularly from an infrastructure point of view. But probably it's a little bit more muted at the moment than some of those other markets. And that's probably because of just people being a little bit more cautious about where China is in terms of a policy point of view. But certainly over the medium to long term, having been again an investor in China infrastructure over the sort of the last 15 to 20 years, we think that is a very prospective market. But probably other markets at the moment are more attractive, either from a need of capital or from a policy point of view.
Ben, I want to get your thoughts as well on artificial intelligence, and not so much, of course, the technology itself, but certainly I've read more than a few articles and research papers that suggest that the world will need a shocking amount of power capacity to simply tide us through this major shift into AI. And I'm wondering, for a firm like yourself that oversees funds, for example, does this already present a viable opportunity around data centers, power upgrades, what have you, or is it something that's less tangible at this point in time?
No, I think it's totally tangible, David. We're seeing the impact right now of AI on a number of our portfolio companies across a number of sectors, particularly things like data center businesses, where there is just a rapacious hunger for particularly hyperscale clients to get more capacity and certainly to contract more capacity, way more appetite than we've seen over the last 10 years. But even in other parts of our portfolio companies, things like our industrial gas businesses that service semiconductor companies, certainly again to be able to support and fuel that AI boom, you're certainly seeing the demand on those industrial gas businesses. I think the biggest question for us is going to be how we then indeed power that over time. And I think working with hyperscale clients, the very big tech companies, working with governments and communities, we're already starting to come up with answers about how we can introduce additional green energy that can help make sure that we've got enough energy to take advantage of the AI boom. So that's certainly a very big opportunity of that. And a large amount of the renewable energy that we are developing today, a large amount is all about sort of corporate offtake arrangements for people like the tech companies so that we can take advantage of the AI growth opportunities, but at the same time be able to do it in a way that is sensible from a net zero point of view and from a community point of view.
Ben, thank you so much for joining us. Ben Wei, the Group Head of Macquarie Asset Management, joining us exclusively from Singapore this morning. We'll leave you with live pictures back at the Bloomberg Wealth Summit in Hong Kong. That is, we're speaking with, there you go, Sonja Laud. She is joining from the Legal and General Investment Management CIO. Also speaking with our very own Eric Shasker. And she's joining us also in the show with David from the event in about an hour's time. We got plenty more ahead. This is Bloomberg.
But it's understanding these. We had a first taster, right, during the pandemic of
Going on to a Bloomberg Scoop, we've learned that Airbus is negotiating a major sale of A330neo aircrafts to China. And the talks are gaining momentum after President Xi Jinping visited his French counterpart Emmanuel Macron last month. For more, let's bring in our Bloomberg's global business reporter Angus Whitley on this. So, 100, that's a pretty big number, Angus. Just tell us, how big of a deal could this be?
It's certainly a big number on any benchmark. More than 100, we're hearing Airbus A330neos. That's the upgraded model of the A330. That's a big wide-body aircraft. And we're hearing the order. It would go to several large Chinese airlines, although the terms of the deal still being discussed. Timing of this deal is uncertain as well. And as is the case with large Chinese orders, it's slightly unusual in that they're bought by a state-owned procurement agency, and then the planes are sort of shared out amongst large airlines like Air China, China Southern, China Eastern. And as you said, what's interesting is that we're hearing that the talks have gained momentum. Talks for this deal, at least, have gained momentum since President Xi's visit to his French counterpart, President Macron, last month.
So, this just, it's such a divergence then of what we're seeing with China and how they're dealing with Airbus and Boeing, which, China has once again halted imports from Boeing so far. So are we likely to see this gap widen even further?
That's right. What we've seen in the past, and we'll probably see again, is that these large plane orders become bargaining chips, if you like, when it comes to political and economic ties. And the progress of these orders, the negotiations when it comes to Airbus deals or Boeing deals for that matter as well, quite often mirrors the status of diplomatic ties or political ties between China and the US or China and Europe. They're both manufacturing emblems. And it's still possible that this planned Airbus deal for more than 100 A330neos could get wrapped up in various other diplomatic disputes. For example, we're hearing today that the European Commission is going to levy duties on Chinese electric cars from July, and we've heard before that sector or that plan could trigger retaliatory measures on aviation. So it's still possible that the Airbus deal may become involved in those kind of issues when it comes to European levies on Chinese electric vehicles, which we know Chinese authorities are upset about.
Angus, thank you. Angus Whitley there, our global business reporter, joining us with the latest when it comes to Airbus. We just got some new data coming through from China. This is the Caixin China PMI services data. So they're coming out better than expected. So that's coming out at 54, which is a sizable beat from what economists were expecting, of a 52.5 sort of print here. So at least looking better than the manufacturing numbers that we've seen, although the private gauge numbers still looked pretty good when it came to manufacturing. It was the official ones where we did see that contraction. And we're seeing basically the highest in 10 to 11 months when it comes to that PMI services print here as well. And what's really helping that? Look, Aussie dollar is being gained, benefiting from it after, of course, that better than expected data as well. We got plenty more ahead. This is Bloomberg.
Don't believe in anybody who tells you that there's a product that's low risk and high return. It doesn't exist. And if somebody tells you that, it's likely that they are scammers and they're trying to scam your money. So you need to protect your savings. That's one. But the medium longer term, I still believe in diversification. That's actually the focus of the exchange fund. Even as a very, very big institutional investor, we're actually playing to diversification. Diversification is the best way to have a even risk-adjusted return in the long run.
Yeah, that was Eddie Yue there speaking with me at just across a couple of meters from where I am right now, of course, inside the ballroom at the Conrad Hotel. A couple of things, right? So I think that was the latter part, Yvonne, of our conversation where we effectively asked him for investment advice, and really, fittingly enough, asking a person where, because of his position, he's actually only allowed to keep his money in bank deposits. Two other things that he mentioned too as well. So they're looking at private credit simply from a financial stability perspective, more transparency. currency. Because there's a lot of money going into that space, so you would imagine it's attracting attention from regulators as as an allocation for a lot of the wealth that's coming through. And the other one was on the Wealth Connect and how they're looking to expand the program. It's a Wealth Connect 2.0 now. They're possibly looking at 3.0. Not a lot of details, but certainly he's laid the groundwork for further opening up as far as those two things are concerned.
Yeah, he mentioned that 3 million yuan investment was maybe not enough for some of these private bank clients. So certainly there is scope for them to maybe raise that a little bit more. But certainly it's just a slew of other guests that we're having for where you are. Ronnie Chan certainly is going to be the highlight there, along with his son Adriel Chan from Hanlong Properties. Adriel, of course, just taking over for the business there as well. So we'll talk a little bit more about the property market in Hong Kong as well as in China. Bonnie Chan, also the Hong Kong Exchange CEO, joining Steve in a long one-on-one discussion there later on this morning as well. Another check for the markets, of course. We are seeing a decent rally that take on here when it comes to Hong Kong. So still seeing Hong Kong better than A shares here this morning. We're seeing gains about 1%. HS Tech is gathering a bit more momentum here. Again, we're up about 1% for that gauge there. H shares also doing quite well. So looks like we're set for another day of gains here. Dollar China a little bit on the weaker side, 725. But that Caixin services number did come out better than expected, which did move some of the currencies here this morning in Asia. This is Bloomberg.
Welcome back. You're watching the China Show. We're about half an hour into the session here. That's a view, of course, of the peak in Hong Kong on your left. On your right is an Hang Seng Index that is coming up slightly off its peak. We're up still about 1.2%. Volumes are on the lighter side of things, about a quarter lighter than usual at this point in time. Certainly, we're still waiting for catalysts, but at least on price, we're higher. Also, in the 8 shares index, bottom of your screens, we're also seeing a rally taking place there. We'll take you straight back now to the Bloomberg Wealth Summit taking place here in the city, and you'll be seeing in a couple of moments, if not already, our colleague, of course, our Chief North Asia correspondent, Stephen Engel. There he is, of course, on stage with the UBS Global Wealth Management Asia and the head there, Amy Low. Let's listen in.
With the property market and some of the high-yield bonds. So instead of being in general, in the past so many years, they've been quite home biased. They're really looking at global diversification, both in terms of jurisdiction as well as asset classes. But obviously, Asian clients are also very versatile. Yeah. So once the opportunity comes, then they will also look at, but all along we've been saying is core and satellite. You still have to have the core, proper asset allocation. And then for satellite, then you can venture into some of the themes or opportunistic idea that you can capture the market flow.
So those trends will be to where? I know your co-head in Singapore is looking at India, looking at Australia. Obviously, the Fed and the yields there have attracted lots of investment, but the Fed might not be, tight for so long. It's higher and for longer, but when it turns, what could be the returns back to this part of the world?
Yeah, I think that's the reason why the asset allocation is so important and really keep versatile and be able to capture some of this opportunity. And to your earlier point, that's also what UBS has been doing, especially with the integration now. It's very complementary because historically UBS is very, very strong in the Greater China region. So with the acquisition, actually it adds into a book the India, the Australia, and also potentially Thailand and some of the Southeast Asian countries. So I think for us, Hong Kong and Singapore still are our core hubs in Asia. And then our strategy is how we're going to also expand and further grow our established market. That includes Taiwan domestic, because we are the biggest foreign bank in Taiwan domestic, Australia, India, and also APAC Switzerland, because we have over 100 plus bankers from Switzerland covering Asia, and 60 of them speak Mandarin. So that's the kind of franchise we have. And then long term, how are we going to grow China and India? Because these are the two biggest growth market in the region as well.
Speaking of the family offices, what still needs to be done, if we talk about this home market here, to attract those family offices that might have left, or trying to get them to come here? Because a lot of the wealth, obviously, with this generational transition that we're expecting, because a lot of, I think 2/3 of the billionaires in China are entrepreneurs, they're first-time money, they need to pass it on, and over the next decade or so, we're going to see a lot of wealth transition to the next generation. So what's the opportunity at hand for Hong Kong?
Oh, there are a lot of opportunity. Talking about the wealth transfer, you are talking about 2.5 trillion asset that will be transferred to the next gen by 2030, according to the WealthX report. So there's a lot of potential for private bank like us to provide that kind of services. So obviously, I think China remains to be one of the top market, because we conducted the survey to all the members bank, because as a chair of the Hong Kong Private Wealth Management Association, basically all the executive committee and the members bank have been telling us China remains to be the biggest growth market. I think what the government has been doing with the capital investment entrance scheme that Eddie talked about earlier helps, because right now we already receive 150 applications, and we also got a lot of inquiry. And actually, my 30-year plus experience, I've been also witnessing a lot of family offices set up in Hong Kong. Multi-thousand, okay, a few thousand. But how are we going to also even attract more to come in? And that's where, again, Eddie referred to this morning about the multi-corridor, the Middle East corridor, the ASEAN corridor, and in addition to the China market. Okay, so I think that's also the different tax scheme will be helpful, because one of the strengths of Hong Kong is the low, simple tax scheme, and also the very well-established regulatory system to protect the investor, as well as the connector, being a super connector, the connectivity that Hong Kong can bring through all these different corridors. I think that will be very helpful.
Did you hear anything from the HKMA, Eddie, this morning on what kind of changes you'd like to see and expansion of the Wealth Connect?
Yes, and actually that's also something we've been advocating and proposing to the government on behalf of the Hong Kong Private Wealth Management Association, because right now, even with they raised the quota to 3 million renminbi, that's not really the segment for the private bank yet. Because especially given the PI regime. So obviously the quota is an area that we need to further increase, as well as the product offering. Because I think one of the strengths of Hong Kong is also the advisory capability, plus also the kind of breadth and depth of the product offering and the platform here. So how we can leverage on those. And the other channel which we also discussed, because right now is more execution only. So how we can leverage on Hong Kong's strength being on advisory. So we've been also exploring potential advisory licensing within the Great Bay Area. So that's also something the industry has been looking into.
But that should be something that Beijing would be open to. They want to create this single market, if you want to call it, with still boundaries, obviously, with HongOng, of the Greater Bay. So what are you pushing for to get that license
That's something we are exploring, and also have been discussing with the industry and also with the regulators there.
Tell me how your plans are affected by, obviously, the integration of the two parent banks now. I understand it's pretty much complete, and that Asia is going to be your priority. Hong Kong first, then Singapore and Japan. What are your plans?
Oh, the integration so far goes on well, and this is unprecedented and historic, despite the fact that this is not the first time I went through the integration with 29 years. Actually, the first one was between Union Bank of Switzerland and Swiss Bank Corporation, the two biggest banks in Switzerland, and I was from SBC. So it goes on well, and actually we just completed the parent bank merger on May 31st. And that allowed us to really deliver the service to our client with a fully integrated team from UBS and CS. And that definitely helps. And then, as you said, then we will have the system migration and the client migration. Hong Kong will go first, followed by Singapore, and then the rest of the world. And so we are very excited because this is really the power of the two, very complementary, both in terms of the platform, the offering, and the expertise there.
Obviously, in the banking community here in Hong Kong, there's been a bit of a confidence crisis. Almost every bank has laid off some employees, including UBS, I believe about 70. But you have one of the biggest portfolio of wealth management advisors, more than 1,000.
We're going to leave it there, but that was UBS's Amy Lowe speaking with our Chief North Asia correspondent, Stephen Ingles. They're at the Bloomberg Wealth Summit here in Hong Kong. Of course, we're going to jump in a little bit later on once we do see some more conversations taking part here. But certainly, we're checking these markets here this morning, and we're seeing when it comes to Asia ex-China, it's still looking a little bit weak. If you take a look at how stocks are doing, we're pretty much flat, and you are seeing some sizable declines when it comes to the Nikkei. The Kospi is still up about 1%, though, so we're still seeing that market doing quite well. And we're seeing a little bit more weakness when it comes to the yen, although it's at 155 levels, so it has sustained some of that strength, or at least loosening a little bit of the gains here. But take a look when it comes to bond markets. It's still that rally that's underway when it comes to some of these Asia bonds. Take a look at how Australia is doing here today. Oil still a big story here today. I think we're on track for 6 days of gains, losses, I should say, for Brent and crude here. We're at $73 for WTI as we speak. And we're talking about China as well. Still seems to be sort of bucking the trend if you take a look at how Hong Kong is doing here today. So we continue to see HSI is doing well and session highs here right now. Dave did mention, though, that volumes are a little bit light compared to this time around. HS Tech, though, seems to be driving that here once again. And we're watching these small caps, though, are heading lower here this morning. But Shanghai crude really following what we've been seeing with broader oil benchmarks here. We're down close to 2% in Shanghai for oil. India still the big story here today. If you take a look at how futures are looking like, though, they were still in positive territory just a few minutes ago. The fact that we heard from Narendra Modi himself vowing to hold power by a coalition did seem to show maybe some of these, maybe we'll see a little bit more stabilization, maybe not, right? If you take a look at some of these ETFs and the like here. But Nifty futures are still punching a slightly higher here this morning. Still a lot of questions of what this coalition is going to look like. This is the first time Modi has had to have a coalition since he took power. And what does that mean for his mandate? And how much of the political capital does he have to push forward when it comes to some key reforms? Let's bring in Madhavi Arora now, lead economist at Emkay Global Financial Services. It seems like there was, if you ask political analysts what went wrong with this election, was that the BJP party maybe focused a little more on this whole Hindu agenda, not so much really capturing this India growth story, right, where there was those that have been left out, whether it's from widening income inequality, you have unemployment that continues to be high, and rising living costs. I'm just wondering, what does this election outcome tell you about what's really happening on the ground in the economy?
Hi, morning. So interesting results, if you look at the, tentative results on the rural point of view as well, rural vote share has fallen around 20% for the NDA versus what we saw in 2019, clearly shows that the rural segment of the economy has not really thumbed up well for the NDA government. If you look at the spending pattern of NDA over the last 5 years, especially post-COVID, there's been a consistent fall in the rural and agriculture development spend overall as a percent of GDP, especially on the revenue expenditure side, which obviously meant that, with the kind of rural stress rather, we were seeing in the economy post-COVID, there wasn't much focus of the government in terms of doing a revenue expenditure-led spend on rural segment. And to that extent, I think the mandate has sort of shown that probably the policy spend should have been partly focused on revenue expenditure as well, apart from capital expenditure.
Do you see, what does this mean for all these, reforms that he had laid out in his campaign, whether it's land, whether it's labor reforms? Do those take a back seat now, or can they still continue?
Oh, absolutely. I think, we are looking at a very different political reality. The equations are being very different, the power equation or the political compulsion that the party will have to now work with. I think it will lead to a policy rethink by the NDA. Thus, I think the factor market reforms, as you said, be it land, labor, agriculture, or capital, or even political reforms with regard to having consolidated elections going ahead, all of that will take a backseat. I think the fiscal consolidation will probably still remain on course in terms of direction. But there was a time especially post-exit poll, where there were talks about the fact that the excess bonanza that the Modi government has gotten from the Reserve Bank of India, which is close to around 0.4% of GDP, would probably be sort of saved by the government, and they'll target a very aggressive fiscal deficit consolidation in FY25 as they come in power. That looks to be a little different at this point in time. I think we will not be seeing a sub 5% fiscal deficit in FY25, and probably a bit of a skew towards revenue expenditure versus capital expenditure. But overall, I think fiscal consolidation versus FY24 will continue. And the broad macro contours are also looking to be, at this point in time, same for me.
Madhavi, David here. So just to pick up on one of your points there, we were speaking with the former RBI governor, Raghuram Rajan, I think it was about a week and a half ago at one of the conferences here in Hong Kong. And one of the things he brought up, which actually stood out to me, was India, the percentage of jobs that is being created in the agricultural sector is actually going up, which is not necessarily a bad thing, but if you look at India and where it wants to be, it becomes a bad thing. And I'm wondering what reforms you think should be in place to get the jobs where they need to be growing for people then to be spending.
I think the policy focus on manufacturing will continue, because that gives jobs for the less skilled labor and probably semi-rural labor, which is where you're seeing a lot of disconnect as well as discontent. So I think that way the policy thought process may not change. I think they will continue to focus on manufacturing-led job creation, because that is the best way to move people out from agriculture to a semi-vocational job skills. I think that will be the next focus of the government, of job creation, and out of agriculture to the industrial sector. And I think construction manufacturing continues to be big favored play there. That's what I'm saying. The policy shift may not immediately be very different from what it was in the past 5 years. But there could be some skewed spend which could give immediate relief to the rural class, or the K-shaped story that we saw in India.
Madhavi, you mentioned the growth clip earlier. Do you think India, in its current, the economic capacity of the economy, do you think 8 to 9% growth is something that we should be expecting from this economy? And also, if that is the case, do you think that becomes an inflation problem, or do you think that is that a sustainable growth clip that we should be expecting?
See, we need to understand the fact that India will enjoy the fruits of past reforms, right? Last 10 years, the policy direction has been very clear. We can debate whether, it led to certain skewness in the economy overall. But I think next 5 years, we should be able to enjoy the past reform seeds. And apart from that, of course, the 7 to 8% plus kind of growth that we saw in FY24, or 8.2% growth that we saw in FY24 was largely technical, right? Because it was a GDP versus gross value add differential that was being reflected because of lower spend by the government of India on subsidies. I think the trend growth, if I remove the noises, should be somewhere close to 6.5 to 7% any which way, which I hope in the next 5 years should continue, hoping that, the reform-led growth story continues. Of course, we'll have to see how political equation really play a part there, but definitely a strong political capital changes a lot of dynamics for any economy. As of now, I think the growth trend is pretty much somewhere close to 6.5 to 7.5%. That doesn't change for me immediately. And FY25 we are looking at a 6.5% GDP growth, which I think is lower than the street. But my sense is that you probably would see correction in FY25 because in terms of trade, a lot of things which were favorable in FY24 may not turn out to be as favorable for us, irrespective whichever equation would have played in the political space.
Madhavi, we'll leave it there. Thank you so much, Madhavi Arora, their lead economist at Emkay Global Financial Services. And we're continuing, of course, on our Indian election coverage here. And we heard from Milan Vaishnav. He's the director and a senior fellow in the South Asia program at the Carnegie Endowment for International Peace. He talked with our podcast team about the state of Indian workers.
People are severely underemployed. They're working multiple jobs. They're working part-time. They're working in the informal sector. They don't have guaranteed wages. They don't have social insurance to a large extent through their employer, right? And so that is the problem that we need to tackle. And I think the biggest thing that they can do there is really try to figure out how to create jobs by harnessing both manufacturing and the services sector.
And you can hear more from that conversation on the Big Take Asia podcast. New episodes drop every Wednesday on iHeartRadio, Apple Podcasts, and Spotify.
Right, so we'll leave you now with live pictures as we go into a short break. The Bloomberg Wealth Summit in Hong Kong taking place, and as you can see on the stage, that is the father and son duo there, Ronnie and Adriel Chan, and the topic of conversation, the property problem. More from the event after this break. Stay with us. You're watching The China Show.
We're bankrupt. The rest of you will be okay, but it won't be particularly good, particularly bad. I was totally wrong.
Welcome back. Let's get back to the Bloomberg Wealth Summit now, right here in Hong Kong, where this is a panel with very own Lulu Chen that's hosting it here right now with, of course, Ronnie and Adriel Chen from Hang Lung, talking about the overall property problem, whether it's in Hong Kong or in China right now. Let's listen in.
Risks of the global community no longer seeing Hong Kong as international and how to address them.
Well, the risk is real. America is stopping a lot of money from flowing to mainland China, and because Hong Kong is now part of China, so they don't want them to flow to Hong Kong as well. So it's all politics. So let's make sure in our own head that we get it clear that something is real economics, something is political. And political things, the wind changes, but it may not change quickly, but sooner or later it will change. So let's not look at a political event and think that it is an economic event only. Of course, it affects the economy, and it affects our business and many others' business, but it's really a political dimension to it that is, beyond our control. I think over time, the whole world will have to readjust. Whole world will have to rebalance. In what shape and form, we're not 100% sure. I have some thoughts, some ideas on it, but it's not going to be the same as before. And so let's make sure, my message to everyone is, let's make sure that our heads are clear. What is political and what is purely economical. And so, when it comes to political market, wow, it's a wild place. So.
And tying this issue back to Hong Kong property, the residential prices are at levels even below before the government scrapped all the buying curbs. What do you think is the reason behind this?
Well, first of all, I think a lot of people don't analyze the fundamental economic reason why Hong Kong's real estate market is being challenged. To me, it's a rather simple one. I've been observing this market, and I've been playing in this market for the last 40-some years. First of all, under the British high land price policy, they still deny it, but it's crazy to deny it. That way, the British companies can repatriate a lot more because less tax here, and because of the high land price policy, you don't have to have high tax here. so they can repatriate more. For Hong Kong people, it's not a bad thing either. Wealth effect make people feel good when the real estate prices go up, and the government can have low salary tax as well as corporate tax. So there are many good points. So the British is the first one that really kept real estate prices up. The second one is Beijing. In the negotiation of 1997, Beijing was afraid that the British will sell a lot of land at high prices and take the money out. And so they make sure that there's only 50 hectares per year of supply. So with limited supply of land, prices continue to go up, number two. Number three, the Hong Kong people. 60% roughly of Hong Kong people own their own homes. We don't want to see prices fall, and real estate has become such a big thing in the economy. You use it to mortgage and start a business somewhere, for example. And then finally, the yellow ribbon people, the anti-government people, the so-called pro-democrat people. They're not Democrat. Don't be fooled by them again. Anyway, so those guys, anything that Hong Kong government want to do, anything that Beijing want to do, they say no. So the Hong Kong government want to sell land, and they say no. So, they probably hate developers, those guys, but they ended up helping the developers to keep prices up. And so when you think about it, for 50 years, starting roughly in the 70s, that these four groups of people have limited the land supply of Hong Kong. And as a result, there's no place to go for real estate prices to up. However, with the 2019 riot on the street, which is so violent, it's unbelievable. When it's so violent and the police is so restrained, I just want to clear it again in history, that those guys are now, because of the national security law and before Article 23, so the opposition, which is purely for political reasons again, not economic reasons. They damage Hong Kong economically for their own political gain. So as a result, once that is removed, for the first time in 50 years, that the Hong Kong government can finally supply land in a more reasonable, more economically sensible way. That means more sufficient. And so when that happens, after 50 years of high land price policy, how can real estate prices not come down? So what's the big deal? Now, of course, I know if you own an apartment, that's a big deal. Or if you want to buy an apartment, well, and you're happy. It's a big deal too. You're happy. But overall, when you look at the economy and look at the Hong Kong real estate sector, we are seeing the biggest structural change in 50 years. And so for prices to go down is to be expected, right? Isn't it? It's so clear.
What is that?
We're going to leave that there. That was Ronnie and Adriel Chen from Hang Lung Properties speaking with Bloomberg's Lulu Chen there. We got plenty more coming up. This is Bloomberg.
You invited the wrong guy to come and speak.
11:29 a.m. in Tokyo. Japanese markets heading into that lunch break, and we continue to see them extending this sort of slide here this morning. Obviously, the yen volatility is one factor here. We have seen actually the yen strengthen about 1.5% in the last two sessions or so. We're seeing a little bit of coming off of that right now, but 155 level certainly doesn't bode well for some of these exporters today. That's why we're seeing stocks down about 0.8% in the Nikkei, 1% losses for the topics here. GGB yields also lower by 3 basis points as well. Your Asia markets dashboard is looking like this here right now. Pretty much Japan is leading that sort of trend of pretty mixed across equities, but mostly lower here this morning. We're flat when it comes to the Asia benchmark. U.S. futures, though, are still punching slightly higher. The dollar is basically flat. Obviously, that U.S. JOLTS data certainly did send a lot of the swaps and the Fed pricing back to maybe putting more rate cuts back at the table, maybe even a little bit as early as September. So that's really not boding well for the equity market, though, just given some of these growth concerns now. But most sectors are still, you could say, in the green in Asia here today. Let's head back to the Bloomberg Wealth Summit. David Ingles is saying bye. He's with our next guest, Dave.
Yeah, Yvonne, thank you so much. Yeah, joining me here on set is Sonja, Laud, CIO at Legal and General Investment Management. She was just, of course, on stage early on here at the Wealth Summit. fittingly enough, talking about uncertainty and investing through that, it's very nice to see you.
Thank you very much.
I just look at the next few months and the major event risk, if we could call it that. The Fed, you could make the argument, you and I were talking, a hike, a hold, or even a cut, or maybe a cut. India elections, U.S. elections. How do you do your job?
That's a very good question.
Yeah,
but
all of this.
You've summarized it quite nicely, right? The investors are faced with an incredibly complex backdrop. So you've mentioned geopolitics, there's politics, and of course there's fundamentals. And we believe it's always very important to really prepare and run the scenarios on what will really matter to markets. Because it's very clear, if you just take a step back and you just looked at media headlines, you could get incredibly depressed, right? Because it's mostly about humanitarian crisis, it's about geopolitics. And then you look at markets and you could believe you're in a parallel world, right? Because markets seem to be actually quite buoyant. And this is why it's important to look step by step and make sure you understand, particularly with regards to geopolitics and politics, how will they influence fundamentals? Because they are the drivers for the actual market narrative. And unfortunately, we have to say, and this is where the disconnect is coming in, so far geopolitics have had very little impact on growth and inflation. And as such, the market is very focused on how these will change and how central banks will react. Now, as you've already mentioned, central banks, we have seen a massive shift in the narrative. We started the year with strong expectations for 6-7 cuts from the Fed, similar for the ECB, Bank of England, and now we're talking about potentially flat, because it turns out that services inflation in particular is far stickier than what we've expected. So investors should really start thinking about how will the US election, we had the India election results yesterday, how will elections potentially influence that narrative? And it's interesting because in India it is potentially a different narrative than in the US. I strongly believe in the US actually fiscal policy is the one area markets should focus on. The starting point is a deficit of 7.5%. Both parties seem to be aligned that fiscal expansion is part of their narrative. And you have to wonder when the bond market will start thinking, okay, there's no term premium right now. Dear government, if we are continuing to support your fiscal expansion, what are you paying? There has to be some sort of term premium priced in just for the state starting point where we are.
And the scenarios for you as far as U.S. elections go, does it need to be first, do we get a clean sweep across both? Is something to consider. How bad is that melt-up going to be, given that both essentially want the same thing? And do I have any business being in treasuries, given what seemed to be almost a foregone conclusion?
No, I think that's too quick, but you're raising a really important point, is the chances of a clean sweep. Because at the end of the day, if whoever gets the White House, we've seen hung parliaments, and we've seen if the Senate and the House are with different parties, you're not getting a lot done. So the clean sweep is what markets should focus on, because as we've just discussed, fiscal policies for both is expansionary, but the Republicans probably would take it a step further. So this is what we will be looking at. The headlines will be dominated by immigration, reproduction rights in some states, so there will be a lot of noise, and of course the legal issues of Donald Trump. But at the end of the day, it is what matters for growth and inflation that will drive the market. Of course there will be noise, there will be volatility, but at the end of the day, looking through this is what really matters for fundamentals that will drive the equity markets in particular, and the bond market. Now, are treasuries interesting? We believe yes, simply for the reason that, of course, again, there will be volatility. And let's face it, we had a lot of volatility in bond markets already. Right. But if you believe that, let's assume we're staying flat, then you still have a good chance that, particularly in the context of heightened geopolitical risk, there is a diversification benefit of including treasuries in your portfolio.
Right. So let's set aside the capital appreciation element of treasuries, or fixed income generally speaking. What role does income play now, I guess, is a question.
Is another very good question, because there finally is income in fixed income. We haven't had this for a long period of time. And even now, if you look at money market funds, you get up to a 5% yield. So this is actually what investors, and we're seeing increasingly that the fixed income complex is looked at differently, simply because you can generate a level of income that we've not had for a long period of time. And we actually used to buy bonds for the capital appreciation rather than the income. This this has now turned around, and that means as well that diversification will be a very different concept now, because in the past, buying the S&P 500 probably would have done a very good job for you. But now, thinking about the geopolitical context as well, we have to assume that the chances of a tail risk event are higher. Can you hedge for that? No, you can't. So diversification will play a far more important role, and this is where, of course, then the bond market will play probably, again, the role that it used to play as a diversification and a hedge, particularly against very volatile markets.
We've actually seen, investors take a step further from that. They've looked outside public markets as an additional hedge, if you will. How do you think about alternatives?
Equally important is part of the diversification narrative, right? So you're looking for uncorrelated income streams, uncorrelated asset classes, and of course private markets will offer you a different profile compared to public markets. And we are already seeing this over the past 5-10 years, that of course the move into privates has played a big role in asset allocation considerations, and we definitely believe that this will continue. Probably different areas. We've seen a big push into private equity as the preeminent driver of asset allocation, but private debt, of course, has really picked up, as is infrastructure. And there's real themes underpinning this. So if you consider the energy transition, decarbonization, that is, of course, themes that will continue, and they will continue to need a lot of capital, which we currently are seeing is predominantly provided by private markets.
Right. I need to ask you about India, and you brought up India. Interestingly, how you described it, how politics affects fundamentals. This is a market that's demanded a premium for a long time. It's trading at double the price of China. Has anything that's happened in the elections make you change your mind? And would you buy this dip, is what I want to get to.
So to start with, it is very interesting to see the outcome of the election, because it's very clear that Modi didn't achieve what everybody expected him to achieve, i.e. that he was able to increase his majority. Why is that? Because we believe inequality has played a far bigger role in the election than originally assumed. If you look at India, what is missing very clearly is how do you provide jobs to the masses? There is, of course, a very strong business case around particular services, the IT industry in that country. But if you compare it to China, what India doesn't have is this broad-based manufacturing that allows you to provide jobs to so many people. And as such, of course, you have the cost of living crisis hitting a large part of the population to a much greater extent than, for example, in China. And of course, his policies so far have been incredibly business friendly. They were growth friendly. And it turns out that potentially he will have to balance this more in considering how he can address that inequality aspect. So what we would expect is that this will have a slightly dampening impact. But we're still talking about the fastest growing large economy in the world. Now, there has been a lot of froth in the equity market, so we probably have to expect that there's a bit of a setback, but we're still very excited about the inclusion of the bonds into the JP Morgan Emerging Market Bond Fund. So there's still a lot of excitement. Just broadening the accessibility to the Indian market, we believe will do a lot of positive, but we have to wait and see what kind of policies and what kind of coalition he can put together to move the country forward.
Sonja, speaking of excitement, it's getting exciting right here, so we have to leave it there. Sonja Laud, thank you so much, by the way. It's nice to see you in Thailand. Let's do this again when it's back. CIO there, legal and general investment management. Yvonne, I can barely hear you. I'm not sure if you're there. I trust you are. It's quite loud here, so anyway, I'm going to throw it back behind me to the Hong Kong studios. Yvonne, hope you're there.
Don't worry.
Yeah.
I got it from here. More big interviews. Great one there with Sonja. Coming up from the Bloomberg Wealth Summit in Hong Kong. Next up is our dialogue with the Hong Kong Exchange CEO Bonnie Chan, speaking with Stephen Ingles on the ground there in just a couple of hours or so. Stay with us. We have more on the India election, of course, and that outcome. Shocker. Plenty more ahead. This is Bloomberg.
What is happening today is really, in the long run, really good for India, because it forces India to choose a different course from the one it has been on, a course which has led to much wider unemployment and distress than needed in the country.
It's a shocker of a result, and there's no doubt, I can't put a number on it, but there's no doubt major part of the bull market in India over the last few years has been the results of the reforms that this government did.
The threats that China poses are kind of across multiple domains, and that means India, knowing that they're outmatched by China on most of those fronts, needs strong partnerships. It's not just the United States, but Japan, Australia, other key partners like that.
So our guests on, of course, the India election and Narendra Modi's stunning setback here and losing that majority in Parliament. We're continuing our India coverage here this morning. I want to bring our Bloomberg Opinion managing editor for more of a perspective on this. Ruth, I know you've lived in India for some time, but it's the outcome of this was something that was so different from these exit polls. Ruth Pollard, can you tell us a bit more about what the message from this election was to the world and to markets?
I think the message was that neither the exit pollsters nor the pundits were listening to the Indian voters when they were looking at how Modi was performing in this election. This election was all about Modi. It was brand Modi. His photograph was on everything from vaccination certificates to bags of rice to posters throughout India during the G7. And voters have said, we're not buying brand Modi anymore. They didn't want his muscular Hindu nationalist form of politics, which basically targeted India's Muslim minority with some fairly heated rhetoric that has no doubt resulted in actual violence on the ground. What resonated with voters this time round, I think, is the opposition alliance's message, and that was around support for unemployment, price support for farmers, defence of the Constitution and social justice for women. And I think if we can take one thing away from that, it's that we need to balance Modi's economic reforms with the more social agenda that the opposition alliance is pushing.
Yeah, and it begs the question of is this not any more about marketing, but really about governance, right? I mean, how do you think this lack of a majority is going to change how Modi is going to lead as a prime minister? And what does it tell us about his future as prime minister?
Well, it must be an incredibly humbling experience for him. It's a setback that I don't think he's ever faced once in his political career. And there's no sugarcoating it. This is a huge loss for Modi. It's a loss of face, and it's a loss of faith in his very hardline Hindu nationalist agenda that he pushed from the moment he took power in 2014. And certainly he escalated that in the lead up to these polls. Modi will obviously have to temper the way he governs if he does manage to form an alliance. He'll need to listen to coalition partners as opposed to taking them for granted. And he'll also need to listen to the message the voters sent to him, which is, you know, we don't want you just to govern for the billionaires of India or for the investors who are flooding into the stock market to make their billions. We want you to govern for us, the voters, as well. And so that's a humbling message for someone like Narendra Modi to receive after 10 years in power.
Do you think this changes at all India's growth trajectory in any way? I mean, when people talk about 8%, even 9% growth for India, is that now at risk, Ruth, you think?
Some commentators are saying it is, of course, and perhaps 6 or 7% growth would be a more realistic figure. Certainly, Modi will have trouble getting some of his economic reforms through the parliament, perhaps. Perhaps it will just take more negotiation to push that through. But nobody's expecting India's growth trajectory to change overnight. We don't have a government in India yet. We know that both the opposition alliance and the government coalition are meeting today. There'll be horse trading going on, and I think it's way too soon to say whether, in any concrete way, India's growth will be less than 8% going forward.
Ruth, great to have you. Thank you so much for joining us. Ruth Pollard there, Bloomberg Opinion Managing Editor, joining us out of Tokyo. You can get more insights on the election results and what it means for India's economy in this online discussion that's happening right now. Our very own Menika Doshi is speaking with Nilkant Mishra, Axis Bank chief economist and a member of the Indian Prime Minister's Economic Advisory Council that is on Live Go for terminal subscribers. And Dave, of course, when it comes to the markets and what does this mean for this India Open after that tumbling of stocks stocks. The rupee, obviously bonds have been vulnerable of late, but are we going to see investors buy this dip, or is this the beginning of some sort of correction? That's the key question.
Yeah, it certainly is, and that webinar plays a very big part of this because information at this point in time is going to be key here. We know investors have overcorrected. They were over enthusiastic on Monday with that pop in the markets. They had to correct, and then even more generational losses. Yeah, I mean the single biggest day in terms of just destruction in the wealth market on an absolute dollar basis we saw yesterday. And to your point, we're getting some stability right now in Indian futures. Here's a 3-day look. That pop we had on Monday, that massive fall from grace on Tuesday, and a couple of hours in, we're about 2 hours into the session right now, and we are relatively stable. It's that tail you see rightmost side of your screens, Yvonne. So we'll see what happens in the next hour, of course. Lots more, of course, in store.
Yep, I think Goldman Sachs just came out with their latest note saying, yes, they are buying into this weakness. So what you're seeing when it comes to some of these economic policies and the like are not really going to change the trajectory of where stocks are going to go. That's according to Suno Cole there. Coming up, we're going to do an update on China's historic space mission to the dark side of the moon and why it may have left a patriotic lunar message. We got the China Brief coming up next. This is Bloomberg. Here's your China Brief, a look at what's making headlines in national newspapers and trending online. Lots of reporting about regulations now. The Shanghai Securities News says China's top SOE regulator is banning firms from establishing or increasing their investments in certain financial institutions. The report says some companies such as Hubei Energy have already put up relevant assets for auction. Another article says the PBOC will accelerate legislation in key areas, including anti-money laundering. The central bank is also reportedly set to expedite the revision of foundational laws to ensure legislation keeps up with the times. And the Securities Times is saying that the NDRC is proposing 5 measures to boost the social credit system. That includes strengthening privacy measures and improving the effectiveness of credit supervision. So plenty to digest on that front as well. Online, though, it's really about space, right? They're more interested in what's been going on with, of course, this just journey to the far side of the moon that China had successfully implemented here this week as well. Officials say that China's 6th lunar lander collected some samples and even left a Chinese flag on the far side of the moon before blasting off for its return to Earth, also leaving a little bit of a patriotic message of late. Do we have that picture? Let's show it. Let's bring in our China correspondent, Min Laud, to explain what's really been the social media response so far.
Yeah, it's really something that has really captured the imagination of the Chinese people because this spacecraft, before it, as it blasted off, it took a picture of what it left behind. And there was this imprint that resembles a Chinese character for 中国的中, which is the Chinese, the first Chinese character in the word for China. And so people are sending around this picture and they're commenting about how proud a moment this is for China because, of course, China was the first to land on the far side of the moon back in 2019, and they just did it again. And also interesting, some commenters also mentioned, kind of make fun of this by saying that, oh, look, the far side of the moon is now an inalienable part of China. It's belonged to China since historic times. So kind of making reference at the standard lines that the Chinese Foreign Ministry often use when they assert their sovereignty over Taiwan and the South China Sea.
Oh, man. Yeah, I mean, some people are like, it looks like a cross. It doesn't really look like a Chinese character. But, yeah, I see it, though.
Yeah.
Take a look to tell us the significance of this milestone for China, really.
Yeah, it's a huge milestone because, I mean, it's an amazing feat of engineering because it's very hard to land on the far side of the moon because of communication issues. You would have to use a satellite to relay communications with a spacecraft, and it's also not very flat. So they had to use an autonomous detection system to find a relatively flat surface. And they also targeted this South Pole Aitken Basin. It is one of the largest and oldest impact craters known to mankind. And the significant thing about landing there is because it's so gigantic, it's 13 kilometers deep. That means it allows the Chinese to pick up samples that could have been ejected from deep within the moon's mantle when this crater was created billions of years ago. So these are materials, soil that has never been seen by man before. The Chinese scientists obviously have first dibs on analyzing them, and then foreign scientists can also apply to take a look at them. And it's all part of the space race with the United States as well.
Yep, very interesting stuff. Thank Thank you, Min Lo there, our China correspondent. Joining us now, on, of course, that moon landing. And we're taking a look when it comes to markets here this morning. Obviously, we're just a few minutes away from that India Open. That's going to be the key thing here. We're watching a little bit more on the EV space. So we talked about the BYDs and NIOs. They did get this approval for on-road pilot of connected vehicles. So we're starting to see that EV trade really flow through here. We're also watching some of those Tesla suppliers. They talked about their China shipments were slowing down a bit as well. We're also watching when it comes to India. There you go. Well, this is what we're seeing across some of these ETFs of late, but futures are still punching higher. We're up about 0.5%. We talked about maybe things might calm down a bit after we start to slowly digest this setback for Narendra Modi and his BJP party. But him vowing to hold power amidst this coalition he has to form now in the government did maybe send some signs that things could be stable for now. Obviously, what was really hit the hardest yesterday was Adani assets, right? We talk about how their infrastructure plans have been aligned with President Modi's, of course, reform plans and the like. And basically, like, take a look at what happened yesterday, right? Basically, close to 20% losses for basically all 10 of Adani stocks that fell. They basically erased almost $45 billion in group market value. That was even bigger than the hit from the Hindenburg research from about a year ago. Biggest one-day loss for an Asian billionaire ever when it comes to Gautam Adani's wealth, dropping by nearly $25 billion on Tuesday. We got plenty on tap. Haz is joining us with more India coverage.